Since last week's video, where we speculated on whether a bear market was in the near future, markets have dropped extremely sharp and fast into what looks like it's teetering right on the edge of a bear market, may even be there by the end of trading today. I'm filming this on Monday, the 7th, so we'll see what happens. Now, at the time that I recorded last week's video, I was literally speaking hours before President Trump released an executive order which sent the market into panic mode. I mentioned that a bear market was likelier this year than other years, but the recent downside movement up until that point of the recording was more characteristic of a correction formation, which is shorter and weaker in its downside than a bear market. However, as with some bear markets, they can be sparked by one single big surprise element that happens in a day, and that was what happened literally hours after I recorded. In my newsletter, I mentioned multiple times in recent months that a market correction was likely coming this year. I didn't know when, but by the end of January, the chances I felt were so high that I took an extra hedged position, which has allowed me to ride through this downside with very negligible loss. I did that not necessarily because I was timing the markets totally, but because I manage my risk at all times, and sometimes more than others when I start seeing certain red flags forming. It just worked out almost perfectly this time around. Now, it won't be that way every time. As a money manager, you can beat markets and most fund managers if you end up being correct 2 out of about 3 times on average. And when you're wrong, you're not completely and devastatingly wrong. All that to say, while I teach investing and wealth building, I also live it in my own life, and that way I'm rarely, if ever, completely caught off guard by my investment portfolio doing something radically scary and unexpected, even in times like this. So check out the weekly newsletter if you want to improve your financial education as well as investment skills in 5-minute reads every week. But let's bring this back around to what's happening right now. What's next? We know what happened. This time reminds me of the market move that happened when commercial flights were shut down during the height of COVID. Remember that? International flights? Let me try to make this as simple as I can. What are investors scared of? Stagflation. That's number one. Stagflation is above average inflation coupled with rising unemployment. Now, how do they think that tariffs and trade wars are going to increase likelihood of stagflation? Because, of course, certain products cost more to produce at home than abroad, and some or all of those costs will be passed along to the consumer in higher prices. Okay, what drives stock prices? Well, essentially, it's the best estimate of everyone together of what the present value of future earnings will be. And those future earnings become extremely difficult to predict beyond about 3 years' time. So the biggest time frame that affects a stock price is about the next 3 to 30 months. When people are fearful, they care more about earnings potential in the very short term, say less than a year. When they're more confident, they care about earnings potential over longer spans of time, like 30 months. All right, next up. What is the average citizen of the US expecting in terms of inflation going forward? Well, the Federal Reserve Bank of New York released the results of a survey on March 10 this year, stating that median inflation expectations increased by 0.1 percentage point at the 1-year horizon to 3.1%, and were unchanged at the 3-year and 5-year horizons, both at 3% in February. Now, that was before the executive order that sent investors panicking. But let's use this data as a hypothetical right now to do a little exercise. Imports make up approximately 12% of US GDP. Let's assume an average of 25% tariffs is placed on goods coming into the US. Now, I think that's a very high estimate because not all countries are subject to 25%, and that number will likely decline as negotiations happen and as countries comply with the demands for fair trade and treatment. But let's go with a sort of worst case that this is the reality for the next 5 years. I'm going to do some simple math, and reality is not this simple, obviously. As we all know, top-down government actions almost without fail have unexpected consequences in other areas. But let's go with what we know. 25% of 12% is 3%. If the common expectation for inflation in the year ahead was 3.1% in February, already knowing that tariffs with our major trading partners were in place, then how do the new tariffs affect that number? Well, about 60% of trade happens with countries other than Mexico, Canada, and China. So if we multiply this additional 3% added inflation and multiply that by 60%, then let's just say that suddenly inflation expectations go to 4.8% for the year ahead. I think that's extremely high in terms of what's likely, but let's just go with it, 4.8%. But just because prices suddenly become more expensive today doesn't create a systemic inflation driver. There's no foreseeable reason I can think of why prices suddenly becoming more expensive today would cause prices to continue to grow at that rate for years to come. It's one and done, other than some supply chain issues that will surely need to be worked out. And that, I think, also, as I just said, is a major exaggeration in terms of what's likely. Even if prices go up 3% or more overall because of these higher cost imports, that assumes companies do nothing to work around these costs, countries do nothing to negotiate lower costs, and the entire cost gets passed along to the consumer. All three of these are incredibly unlikely, but let's just stick with this because I want to illustrate why I think this is such an overreaction. Okay, so year one, let's assume 4.8% inflation. Year two, let's go with 3%. 3, 4, 5, all 3%. Let's just assume that because that's what people apparently have been assuming, and that's not likely to change just because of this immediate rise in cost potential in year one. Where does that leave us in 5 years from now? That leaves us with overall prices higher by about 18% in 5 years. What if President Trump hadn't placed extra tariffs on other nations last week? Well, let's assume 3.1% in year one, and then 3% for years 2 through 5. 5 years from now, that leaves us with higher prices by about 16%. So 5 years from now, higher prices of 18% versus 16%. And that's assuming some pretty incredible cases of inflation caused by these tariffs. Annually, that's an average of 3.365% versus 3.013%. Okay, now let's do some simple math. The present value of 100 using a 5-year time horizon and 3.365% discount rate is 84.75. The present value of 100 using a 5-year time horizon at 3.013% discount rate is 86.21. What's the difference between these two figures? 84.75 divided by 86.21 is about 1.7%. The market's dropped nearly 20% as of this recording so far. I don't think the market should have moved almost at all, maybe 2% at the most to the downside because of this new tariff announcement. But I do think the markets needed to either coast sideways one way or another, either through a flat line, which virtually never happens in markets, or through a major down movement that's followed by upside over several months. That's why I bought the hedge. Tariffs were the trigger, but is it going to cause a recession? I don't see it. And if we're not headed for a recession, then a bear market is not likely to last very long, if it even develops, and it's likely to recover pretty quickly. Where should markets be right now? About right here, right where we are, in my opinion. Now, if they drop another 10% from here, I think that would be a massive buying opportunity. I don't think it's likely to drop much more than that from this point for a number of reasons, which I go into in the newsletter. But here is a warning. Normally, when bad news hits markets, other bad news also tends to crop up in the news. That's partially because bad news is always happening, but emotions are particularly prone to click and pay attention to bad news when markets are dropping. And clicks mean views, and views mean advertising dollars. So in the weeks ahead, expect to read and hear more news that surprises markets and makes you think, what? First tariffs and now this? The world is absolutely falling apart and going crazy. Normal. It's all normal. It's the way the world works, it's the way the media works, and it's the way the markets work. So all the while, the future successful investors will be buying up the discounted prices. All right. Let's take a look at some technical analysis, which by itself is not a real useful tool and can be extremely deceptive in inventing meaningful patterns. But evidence appears to show that there is some degree of predictive power when combining multiple indicators with more fundamental analysis. So here we go. The Shiller price to earnings ratio is now below its 10-year average. That is a positive sign for the future. If markets drop another 2 to 3% approximately, they will be approaching what's called the golden ratio, down 61.8% from their most recent uptrend that lasted from October 27, 2023 until February 19, 2025. They will also be approaching the support level from April 19, 2024. That's a double support level around the range of 48.91 and 49.67 for the S&P 500. The median point of this range is about 49.29. If markets drop another 13%, the Shiller price to earnings ratio will be pushing what it was at the bottom of the 2022 bear market. Downside likely from here, I estimate between 2% and 13%, but I really don't think we're going to hit the lower end of that range unless the next media headlines of shock value have some truly fundamental surprise that shocks markets to the tune of $1 trillion or more. If I'd been sitting out of markets right now, I'd be looking to buy in. If I'd been riding through this market, I'd be staying put. If I'd hedged the market, which I did, I'd be looking to take some profit off the table, and I already have. Markets will likely continue to be bumpy for the weeks ahead, and even months, but in my opinion, I think this downside is exactly what markets needed. Not because of tariffs, but because of overhype of artificial intelligence and deregulation, which caused markets to get ahead of themselves. From here on, I believe the upside for a year out from now is far more likely than downside. Of course, with ups and downs, as always, and larger swings both ways in the weeks to come. Now, as a reminder, this is not financial or investment advice of what to do in the markets. That can only be given by a licensed financial advisor who knows you personally and knows your situation and how to weight the odds in your favor based on that data. But I give my opinions here simply to illustrate how various types of analysis work and how you can navigate the markets and learn the strategies I've learned over the years as a former advisor and analyst. Now, let's finish up with just a summary of what these tariffs are all about. Right now, we're watching America wrestle with a sort of economic paradox. Any economist will tell you that global trade makes everyone better off. That's because different nations have different resources and different strengths, whether it's due to culture, resources, or other characteristics of geography. Free trade saves everyone time and therefore money because of this efficient division of labor. Economists know this. President Trump knows this. But economics is not the only subject that matters in the interest of a country. Of course, so does national security. Let's bring this around to a personal finance example for comparison. Any good financial advisor is going to encourage an emergency fund. That is typically a savings account that holds enough to pay for around 3 to 6 months of living expenses in case of a job layoff or other emergency. Same goes for emergency preparedness on a very physical level. Emergency preparedness involves having a ready supply of necessary items, mainly medicine, shelter, food, and water in case worst comes to worst. Here's the question. In our day-to-day lives, does an emergency fund in a savings account earn the highest return on our money? No, of course not. Could we spend our money on something more useful today than extra water and food in preparation for an emergency? Yeah. But that's not the way to have sustainable well-being. It only lasts as long as it lasts, until there's an actual emergency. Only then, when it's too late, do we wish we had made the investment to prepare. While I'm not privy to every detail that the Trump administration is dealing with in regard to these decisions, and I don't know what they will mean for the immediate future, it is quite clear why they are being implemented. Russia invaded Ukraine, the deadliest European conflict since World War II. Hamas and Israel have gone to war. U.S. relations with China have soured since the days COVID unnecessarily wreaked havoc on the world. And until now, there have been whispers of deglobalization that reduces trading relations largely into 2 or more trading blocs among countries who share interests, belief systems, and values. President Trump's administration believes that the U.S. absolutely must be independently able to produce military equipment and sufficient food supplies to protect and sustain the American people without requiring dependence on foreign nations. Ukraine has offered a recent example of a nation that cannot manufacture its own military equipment with sufficient speed when left to itself. America does not want to find itself in such an emergency situation, especially as global tensions with Russia, China, and the Middle East have escalated in recent years. The relative success Russia has had against Ukraine is a stark wake up call to what remains possible in the present day. And the COVID crisis also offered an example of how too much reliance on foreign countries can affect the US negatively in times of emergency. In short, managing global trade is a balance between efficiency and security. There's actually nothing wrong with a trade deficit. Trade deficits happen. Money flows out of the US, but US dollars get deposited in foreign banks, and those banks buy, guess what? US treasuries to earn interest on those deposits until the time that they're needed again. So the money flows back into the US government. No harm done. But it's trade imbalances to the extreme, artificially, due to unfair practices and other things that do create a problem. It's like creating a muscle that goes unused. Too much imbalance weakens certain sectors of the US economy unnecessarily to such a degree that we lose our preparedness for a global or domestic emergency. And that's the reason for this national emergency recently declared by the President of the United States. Whether it successfully does the job it's intended to do or not is up for speculation. Whether it's the right thing to do or not, I don't know. No one knows or really can know at this point. But the logic behind why it's being done is not about economic efficiency. It's about national security, number one. In the end, this policy shift isn't about getting the highest return. It's about being prepared, like an emergency fund. It may not be efficient in the short term, but when a crisis hits, national sustainability matters far more than short-term performance. So while the immediate future remains uncertain, and that's likely to keep markets busy making big moves both ways, it's important to keep our heads and know that psychology causes markets to swing wildly in the short term, but fundamentals drive the long-term trend over a year or more. It's going to be all right. Now be sure to subscribe if you enjoyed this content and join me over at thewealthexpedition.com where you can receive a weekly newsletter, take courses, and soon subscribe for even more in-depth material with monthly membership access. In the meantime, keep calm and carry on. I'll see you again next week.